And yes, so the meeting will be recorded. As I was telling to our panelists today, we had 50 registrations. So we believe more or less 20, 30 people should be connected, but not to waste the time, considering it's only 1 hour, 1 hour webinar. We can kick off. The meeting is recorded, so afterwards we can share the recording, and we will be sharing slides also with everyone else who registered. So let me just share my screen. So we can officially, yes, kick off this first webinar, Tap the Untapped, number 1, making capital additional. So as you might know, this is part of a new series that we have just launched at Impact Europe, which is Tap the Untapped, and the idea is to have 3 webinars where we will be sharing new insights coming from the data we have collected together with the European Impact Investing Consortium, which is a partnership between Impact Europe and the European national partners of GSG Impact. And we will be joined by experts that will share insights to understand a little bit how to unlock more capital for impact. And this is the first one. We will have a second one on the 7th of July, next Monday, and then the last one will be on the 17th of July. At the end, I will be sharing the links, so you can also register to the upcoming 2 events. Today, I'm here with my colleague Alessio. I'm Alessia Gianoncelli, Director of Knowledge and Insights at Impact Europe, and we have the pleasure to have 2 members of our community, Alice Carle from Inco Venture and Peter Wittek from Tilia Impact Ventures. We will have a panel discussion in the second part of this hour, and in terms of agenda, very quickly, I will give you a few insights on data to introduce the discussion. Then Alessio will be sharing with you the key insights of the day. So we were able to come up with additional insights thanks to the work that we have been doing on our internal dashboards. We will have also interactive polls. We would like to hear from you. We have prepared 2 questions. And then, as said, we will have the panel, some time for Q&A. We also have extra questions, but I will encourage you to share your questions in the chat, so we can try and address all your queries during the hour, and then some closing remarks and some links to share. So I will start saying that, as you know, the situation right now is a bit complex in Europe, but also worldwide, and we are far from achieving the SDGs. So I think you might be familiar with this data that I'm going to show to you now, but if we look at the data that the OECD shared, there is still an annual gap in terms of achieving the SDGs, only looking at developing countries, which is $4 trillion. And also looking at the United Nations statistics, we see that only 70% of the SDGs are on track, while 35% are either in stagnation or in regression. On top of this already complex scenario, I wanted to highlight some other insights and data points which are related to the fact that also public funding and foreign aid are shrinking, despite the need for more capital. So the OECD just published some data saying that the official development assistance is set to decline in 2025, bringing a net add, let's say, between 186 billion, if we look at the lower cut scenario, to 170 billion. So again, a significant cut on top of what is happening on the USAID side, where over 80% of this funding is to be cancelled, but it's not actually only a trend that is affecting US, but other countries also looking at Europe are actually reducing this aid allocation, which is actually creating an even more severe crisis in terms of capital mobilized. And if we look at our market, the impact investing market, and this is data that comes from the latest survey we published at the end of last year, we see that actually this small circle represents our direct impact investment in unlisted assets, which we estimated being around 190 billion. The good news is that it is a growing trend, but if we look at our market, it only represents 2.5% of all the total asset under management that we consider eligible for impact investing in Europe, which is something around 7+ trillion. So again, we would need actually to mobilize more capital. The good news is that we were able also to estimate how much of this capital is additional, so 62%, which is a good result. And I would say that this is a trend that we would hope to see growing in the future, because actually this is the message that we wanted to bring to the table today. So we need more capital, bringing in additionality. Additionality, for those of you who might not be familiar with the term, is one of the three elements that are defining, let's say, impact investing, but also investing for impact, together with intentionality and measurability and impact management. And when it comes to additionality, we mean by this term the quality of an intervention and investment to add something that some effects that would have not been achieved without the intervention or the investment itself. So it's really the capital that can be transformative, and it's the capital that can bring to a systemic change. Just for you to know, we normally refer to two types of additionality: the investee additionality, so the intervention that investees and grantees are carrying out on the field, and at the investor level, which is something that we track through what we call investor contribution, and can be either financial or non-financial. The focus of the insights that Alessio is going to present to you in a minute is focusing actually on the investor contribution, and also the questions that we will be asking to Alice and Peter will be focusing on the role of investors in bringing additionality into the picture. So Alessio, over to you to present these new insights. I'll keep sharing the screen, but I'll mute myself. Yeah.
Thank you, Alessia. So let's move to the new data of today. First of all, let me show you the map of the partners that contributed to the data report in 2024. The report that we launched in November last year is titled "The Size of Impact." And here we provided an aggregated overview of the European impact investing market. Today, we're actually doing more in-depth analysis on a subset of granular data that were shared within the European Impact Investing Consortium. And moving to the next slide, we can see the additionality rate within this group. And we can see that 71% of them are additional. And this actually is reflecting what we said in the size of impact, that is that additionality is growing to be a key characteristic in this space. But looking at the strategies with which investors can be additional, we see that 33% of them are only financially additional, for example, through accepting lower returns compared to the market rate, or by adopting different capital strategies. Then 16% of them are only non-financial additional, so through the provision of non-financial support that is in depth and continuous and aim to really enhance the impact performance of the investee. And then 22% are both financially and non-financially additional. And here, an immediate, let's say, takeaway is that when we think about investor additionality, we often mention returns and the financial aspect of the investments. But here, what we see is that 38% of investors have actually non-financial additionality as part of their strategy, or even as the main element of their strategy. And this is suggesting that we shouldn't forget about the role of non-financial additionality. Otherwise, we will miss a substantial part of the picture. And we'll also talk about this with the speakers later. But then focusing on financial additionality, we can now see an overview of the strategies that the associated impact investment vehicles are adopting in order to be financially additional. And what we see is that there is not a significantly predominant strategy. Yes, at the top, we can see that accepting lower returns is the most adopted strategy. But then, as you can see, there are similar proportion of vehicles, for example, addressing underfunded sectors or geographies, showing flexibility, providing patient capital, and also accepting disproportionate risk or uncertainty to create positive impact. So what we can say is that financial additionality is not just one sacrifice, one action, but is really a suite of intentional capital strategies. And concessionality is certainly emphasized, but it is not the only strategy to pursue financial additionality. And then staying in the topic of concessionality and returns and additional impact, what we said so far is that concessionality is indeed a crucial part of additional impact investing strategies. We saw that 75% of vehicles are accepting rate of returns that are lower than the market rate, but it's not the only one. But what about those investors that are targeting market rate of return? How can they be additional? And here we will look at 46 organizations that are targeting market rate of returns. 50% of them are not additional, but then 28% are non-financially additional, 50% only financially additional, and then 7% both financially and non-financially. So this means that 50% of organizations that are not concessional, meaning that they're not accepting lower returns, still manage to provide an additional investor contribution through, for example, non-financial support or the other capital strategies that we have seen in the previous slide. So the data are basically suggesting that market return expectations do not preclude additionality, that in turn can and often does coexist with commercial performance goals. However, concessionality still remains the primary driver for additional impact. Thank you.
Thank you, Ale. And then maybe before asking questions to our panelists to understand a little bit more what they think about these additional insights that we were able to come up with, I wanted to see with you what are your perceptions, let's say. So if you can use the link that Alessia is going to share, you can access the Slido, and we have two questions for you, just to sense a little bit also the feeling of the people in the room, knowing that again the debate on additionality and on financial returns is something that is still a hot topic into the field. So the first question that you see, so you have the QR code here on the screen, so take your phone or go to the link that Alessio shared. We wanted to understand from you which of the following elements best reflect your view of additionality. Again, here we are mixing the characteristics of financial additionality, and also we look into the non-financial support. So the first one is targeting lower returns, so being concessional. The second one is addressing underfunded sectors, providing patient capital, accepting disproportionate risk, being flexible in shocks and crises, and providing non-financial support. I see people have started voting, which is yeah, it's a multiple choice, as you can see on your phone. I would encourage those that didn't vote yet to still provide me with an answer, so we can have more responses. And we will be using also these responses to, again, keep stimulating the debate, considering, again, the interest that this discussion has sparked in the past years. So for the moment, the most voted option is addressing underfunded sectors and/or reaches underserved populations, which makes sense. And then we look into the patient capital. Targeting lower returns is the least voted. I don't know whether you were a bit biased after what we just shared. I would have expected an higher results, but then again, with Alice and Peter, we can focus on these. So I will pass to the second question. The poll will not be closed, so you can keep voting. And the second question is specifically about financial returns. So, pardon. So please indicate how much you agree or disagree with the following statement. Market returns cannot coexist with impact. In fact, lower returns are fundamental to providing additional capital. Again, one, if you strongly disagree with this statement, until 5, where you strongly agree. So for the moment, yeah, we have a few people that are answering. Let's see. So there is, for the moment, a strong disagreement on this statement. So going back to the fact that being concessional might be an option to bring additionality, but not definitely the only one. And again, our panelists will share their views in a second. Okay, so strongly disagree, 42%. And then we have a mix of in between options. And we don't have anyone connected today that strongly agree. Again, I will ask Peter and Alice to tell us what their views are. So without further ado, I'll stop here, and I would like to call Alice and Peter for this panel. So I'll stop sharing my screen so you can see me, but also Peter and Alice. Voila. So considering we just showed some data, I would now love to hear experiences from practitioners from our community. So I would start with the first question for both of you. And I would like to ask you, while introducing yourself and your organizations, can you tell us in which way your organization actually bring additionality, whether it's financial or non-financial? And I would start maybe from Alice. So over to you, Alice.
Thank you very much. Thank you for the invitation and for all this useful insight on additionality. So my name is Alice Carl. I'm a Chief Impact Officer at IncoVenture. Previously, I worked for 5 years in a deep tech incubator, and I also did a PhD in impact measurement for startups. So just a word on IncoVenture. We have more than 130 million assets under management. We have 5 funds, all dedicated to impact, and more than 130 companies in the portfolio. And also, IncoVenture is part of a bigger group, Inco Group. And within Inco Group, 69% of our operating incomes are from non-profits. And so how we perceive additionality at impact at Incoventure. So we consider ourselves, after reading your study, as additional impact investors. So on the financial part, so 68% of our finance companies are recognized by the states as contributors to the social and solidarity economy. So SSE in France is ESS. I think it's kind of similar than what you can find in the UK in terms of community interest companies, or in Belgium, accredited social enterprises. And Italy, sorry for my accent, Impresa Sociale, I've heard of this kind. And so, yes, 38 millions of our funds are used for non-profits and cooperatives. So we do provide capitals for companies whose financial needs are poorly or not addressed. And this is a huge part of our additionality, I think. Also, 4 of our 5 funds are evergreen. So we also have patient and flexible capital. And by doing all that, we hope to provide market signal that that financing this kind of companies has a lot of value. So that's on the financial part. And on the non-financial part, so we consider our additionality to include everything we do in terms of shareholder commitment. So to be included in governance, voting in boards, and also all the action we do to help companies to develop their strategy and to structure their impact measurement. So it's more my side on impact measurement. So through individual training, to put them in contact with specialists or peers, and to organize collective workshops, for example.
Thank you so much, Alice, for these insights. And then over to Peter, so we can also hear from your case.
Yeah, hi everyone. I'm really happy to be here. And shortly about myself. Over the past 25 years, I've been, partly in the NGO sector and partly in the business sector. The NGO sector was always a volunteer work. I spent 10 years with Amnesty International and various other organizations. Currently, I'm on the board of 7 organizations around education, biodiversity, early childhood care, supporting Ukraine to win, empowerment of women. And I try to mix it with, an entrepreneurial and business background. Spent 9 years at Deloitte and then started a social enterprise. So I'm a founder myself, turned impact investor. And together with Silke Horak, we co-founded among the first impact investment fund in CEE, in the Central and Eastern Europe, called Tilia Impact Ventures. We started with a rather small fund, €2.5 million, 7 years back, that had more of a blended capital mezzanine structures. But our current fund, our second vintage, that's 30 million euros, has more of a standard VC impact capital strategy. And we can talk about it a little later. And yeah, thanks, Alice. I think you nailed it. For me, impact and financial additionality, these are big topics. So, it's like when I heard Alice, I was like, being additional is being like a good partner, right? Being a good investor is being like a good partner to my wife and to my kids and to my friends and to my fellow citizens. So I always say to my wife that it's 2 parts science and 1 part magic, that it's about trust and it's about caring, right? For the causes we're all kind of invested to, either financially or emotionally or relationship-wise. So it is, yes, intentionality, commitment to impact measurement, but also for caring and with empathy. And I think you couldn't be a good partner, either financially or impact-wise, if you don't care about the outcomes the founders are, why they established the impact organization. And there is also one element: caring is not enough. I think it's important to also be understanding and that's not possible without deep analysis and understanding the evidence-based cause and effect relationship about the impact value chain, the interventions we're trying to do. Because I also saw it that even if you care and don't understand that, you can create more harm than good without even knowing that.
Thank you so much, Peter. And maybe I'll keep going with you because I wanted to hear your thoughts about the results that we just showed. So we have seen that 71% of respondents were identifying themselves as additional. It's a huge percentage, and it should come with everything that you and Alice just shared in terms of strategy. So did these results surprise you, or do you see lots of impact investors that are additional nowadays? What's your view on the field? Also, maybe looking at your precise area of work, so Central and Eastern Europe, any thoughts? It would be welcome, and then I'll pass it to Alice.
Yeah, just a a disclaimer. I don't have a representative data, of course, right? I can just say from my experience, and we often co-invest with VCs that don't call themselves impact funds, but they see the business potential or the commercial potential in the investment, and they happen to also care for the cause, right? And I think it's actually quite hard, and I often have doubts whether we can really add value. Because who are we to tell the founders to do it in a different way, right? And even the best intentioned piece of advice could be wrong advice. I've been wrong before, and I'll be wrong in the future. So I think that additionality is also about being humble and having a relationship that's based on trust and radical candor. And then I think that relationship can be then transformative and actually create some added value. So let me illustrate, the thing I love about my job the most probably is when are these moments when the founder calls you and says, well, my co-founder is not performing and I don't know what I should do about it, right? And I'm alone in this decision. Why don't we go for a beer and discuss that? And in those moments, I think we as investors can add a lot of value. And in the board meetings, sometimes you need to break the rules or do something a lot of crazy and high risk to actually change the system. And I see the board views or members of the boards having totally different opinions, right? So I think the diversity of opinions also can add value for the founders. But I just wanted to name it that the founders are the ones who ultimately need to take the decisions. And I sometimes just don't know, right? These are difficult things. So I would be a little, sensitive or about saying that we investors we have this magic wand and whatever we touch we turn into a best advice or impact or gold or something. And we're humans and we have our biases, and I think it's really important that we have this partnership and humility based approach with the founders, and perhaps if we work together based on deep collaboration and caring for the cause, and can tap into the collective intelligence, and then the concepts like patient capital and things like that are just tools. But I think the prerequisite is really changing the way or improving the way we collaborate.
Thank you so much, Peter, for the honesty and also for the tips on offering beer might be considered an additional strategy. So I will quote you in my next webinar. But going back to Alice, was this a surprise for you, this great amount of investors self-identify themselves as additional, or you see this happening, considering everything that we said on the funding gap that we still see in the market?
Yeah, first I will strongly agree with Peter who said that you have to take into account like the entrepreneur perception, like in adding value, because we could also create a bias by saying, okay, to be non-financial additional, then you have to be very much implicated, and sometimes there are companies working great without much investor implication. So I think it's a very good point. And concerning the results, I would say that I was not surprised, but it raised a question to me whether I think it might be difficult for people to answer this kind of survey, because the definition is not so clear on additionality. I mean, the definition is clear, but you don't know how, at what point is additional activity taken into account. So, for example, I will quote the work done by Institut de la Finance Durable. I saw that Leo was here also. So they created an evaluation grid to assess whether you have impact as an investor, and it gives you a grade and it gives you perspective on which points can you do better. And so, for example, for additionality, they identified in the literature 6 mechanisms. So flexible capital, financing market that is underaddressed, non-financial support, shareholder commitment, market signals through exclusion policies, and market signals through lobbying and communication. And you have different kind of options. So either you enter in none of these mechanism, at least one, but in terms of market signal, at least one other than market signal, or more than one other than market signal. And so I'm not surprised that 70% of impact investors can provide one of two of these elements. But I would say that I was more surprised that this category was created, so additional impact investor, because the question that it raises is, should these 30 other persons should be considered impact investor or not? Because we agreed on 3 pillars. So this is something that I think the study raises as a question, but we talked about it, and I know that additionality is a huge topic, and I think it was a great point to have this study to better see all of the practices that we do very differently. So in this respect, it's very precious.
Thank you so much, Alice. Maybe a few points from our side. We are refining the questionnaire for making sure that whenever we ask these questions to practitioners, there will be less space for subjectivity. So we're really trying to make sure that we can track these elements in the most subjective way, which is of course complex, because we are still talking about people answering surveys. And then on what you said on Institut de la Finance Durable, we are collaborating actually as Impact Europe with this idea of looking at all the labels and certifications and methods that are out there, and trying to come up with a self-assessment that we can use for our own members precisely to do that. So we will build on the work that has been done in France, and as we announced during our AGM, we should be ready with something at the beginning of 2026 that is linked to what I was saying, the questionnaire, the new data collection that hopefully we will launch in Q1, again in partnership with the European National Partners of GSG Impact. And then also, Alice, thank you so much for raising this point on should additional impact investing be a separate category? There were plenty of discussions, as you can imagine, in the past when we published the 5 W's report. And the main question was, should we really still be okay with investors that are not bringing additionality and define them impact investor. The overall decision, looking at the national partners that we have in Europe, was yes. But then what was very important for us was to be able to track this additionality in practice, to then be able to say, okay, there are strategies that can really be a bit more transformative than just impact investing as such. So all good points, and again, showing that there is a debate ongoing. So also from the attendees, if you have any questions or comments, or you would like to be engaged in this discussion, feel free to reach out to us. And then maybe I'll go back to Peter, sorry, for the additional,
No problem.
an additional question. So as we have seen, our research indicates that financial additionality is often achieved through different capital strategies, not just by accepting these below market rate returns. But I would like to understand, in your view, when you think that concessionality is truly necessary to achieve additionality, so accepting, I mean, lower returns might be the transformative element, or when do you think this the importance of accepting lower returns might have been overstated? So again, a controversial question, but happy to hear from you. And then Alice, if you have anything to contribute before going to the next question, happy to hear it.
Yeah, thanks, Alessia. I mean, before I try to answer this question, I'd like to come back to what we discussed previously. And, you know, I have the feeling that for a lot of our people outside of our IMM bubble, this conversation would be very difficult to digest, right? Because there is a lot of complicated concepts. And also some of our founders, they go more with a gut feeling rather than a complex IMM approach and thought through methodology. So one of our tasks is actually to be a good companion and a partner to actually develop that and document a little bit what they're trying to achieve. And where I struggle is simplifying and explaining in simple terms what we're actually talking about. So if you can help us with that in your research and in our conversations, that'd be awesome, because I feel that there is so much loss in translation when we start super complex, and I think that needs to be, our conversations here also need to be accessible to people outside of our bubble. And I find it personally really, really hard to have those conversations without compromising on the content, but at the same time not threatening the people by the complexity of the topics. And when you discuss additionality with people who have never really thought about it, it's kind of a hard thing to digest at the first sitting. So I just wanted to name that also the way we communicate about it is very important, and we need to actually bring people together rather than divide by something that's really, really exclusive to be part of, because it's just so complex. But coming back to your question, I'll try to be short. Again, concessionary capital, very complex. In our approach in Tilia 2 fund, I think the key word is portfolio approach. We are seeking market rate returns, and at the same time, intentional, ideally systemic lockstep, additional impact. And sometimes it's possible and sometimes it's not possible, and then we make concessions. But we cannot build the whole portfolio just based on that. So if we see a huge impact potential, then we're ready to make concession or on accepting higher risk, or accepting lower return. And that's because our thesis is that we're seeking market rate returns, but at the same time being an impact first article, SFDR Article 9 fund. And I believe that sometimes there are no trade-offs, but very often there are trade-offs. And it's good to be mindful about it And that's why the second Slido question, I think it's difficult to answer. And of course, I would like to see a world where green premium is not happening and externalities are priced in, but they're not, right? And when you're creating positive externalities that are really, really difficult to monetize, then it's part of the problem, and we're trying to address it through our investments in one way or another. So I will probably pause here and let Alice complement. But the portfolio approach and building a diverse portfolio investments, I think, is belief, and that would allow for some concessions. Luckily, given our LPA, we're not chasing IRR, so we can be a little more patient with our capital. We're chasing, of course, impact, but the overall return, and luckily time is not the key variable, unlike standard VCs. Yeah. Alice, over to you.
Thank you, Peter. Indeed. Alice, anything to add?
Yeah, I was thinking about what you started with concerning the fact that this discussion is difficult to understand for people who don't usually work on this topic. And on my side, I never talked about intentionality, additionality, and measurements to an entrepreneur. Like, I don't think there is much value for them to understand all this complex topic. Like, if I had some time with them, to what bring value to them is what I can provide to them in terms of impact measurement, what they can do for their company and stuff. If they are raising funds, maybe. But like in my previous life, working in an incubator, I would sometimes explain to entrepreneurs, okay, not this VC is not crazy to ask you this question. It's because there is something called SFDR, but you don't care about this, but just this question comes from that. But I don't think this is where we add the more value for entrepreneurs to understand the complexity of this discussion. But I'm not sure about it. I was just thinking about that. And then on the portfolio approach, so for example, just to put some numbers, on our funds that we currently have, we are targeting 3 to 5% of revenue. So I would say that we don't have we are concessional, and in our portfolio we have some company that we know that we hope we have great return, and some that we fully acknowledge that it's low return, and it creates balance. And also we hope that it creates a community when impact entrepreneurs can also see that there are different approaches to target social or environmental goals. So strongly agree on the portfolio approach.
Thank you so much, Alice. And indeed, I think that's the language problem and the complexity is something that we should address. So definitely not interesting for funders and enterprises. We will tackle this question in the third webinar, where the focus would be on potential investors. So whether this might help actually in fundraising or in attracting capital, or maybe not. So more to come on that. And maybe Alice, staying with you, I wanted to ask you a question on non-financial additionality. So we have seen that half of the investors that are targeting market rate returns are still additional. So mostly providing this non-financial additionality. So what is the role that you see playing by the non-financial additionality, but also is this can be the lever, the main strategy for commercially oriented investors to really trying to be additional and bring a transformative impact? What's your view on that?
I think I might repeat what Peter said on the fact that you have to be a great partner and to care about entrepreneurs and to really have this human dimension of additional fun, if you are talking about non-financial additional value. But then if we come back to the expert discussion that might be complex, is that how you measure that. For example, how can you define that you have non-financial additionality? Like, for example, if you go to an event once a year and you put in contact two entrepreneurs, then is the box all good, or should you do more? So that raises the question of how can we measure this non-financial additionality? And I can share some insight about what we do at IncoVenture, but it's very oriented expert discussion, and I don't think it's bring that much value for entrepreneurs, but maybe for us to evaluate our additionality, it's indeed useful. So for example, we send every 2 years questionnaires to entrepreneurs to ask them how we help them in their operational problematics. So we did that for the first time in 2023, and it was useful. Like we saw that 77% of them said that they were satisfied with our level of support. So that was also useful to maybe identify, because it was not anonymous, identifies those who did not agree with them, to so that, like, are you happy with the fact how we support you, or should we do more, should we do less, what is the right point for you? So it's good to have this data to then adapt, maybe because you can think you are a good partner, but maybe sometimes it's not the case. And we also measure satisfaction when we do collective workshop. And what we are working on currently is how to better track our shareholders' commitments. So by creating a data room to see, like, when we participated to board, when we voted and stuff. And I would say that it's mostly because we like data to adapt and make decisions, but it's not key to be financial, because as Peter said, the human part, I think is what imports the most.
Thank you so much, Alice. And yeah, 2 comments on that. Again, as you said, it's important to understand what kind of non-financial support you provide and how often. Otherwise, it's easy, as you said, being just in a meeting, doing one connection and then pretending to be non-financial additional. So what we are looking into is really how in-depth the support is and how continuous is. So it should really be something that, in terms of investor contribution, is strong enough. So again, we wanted to make sure that we have elements that can be truly transformative and supportive. And also, I think that when it comes, yes, Alessio just shared some resources in the chat. We have tried to explain a little bit all these complex story through the links, and maybe just to remember, to remind you all that the data that we are presenting now are just on impact investing, which is part of what we do. So we also collect data on catalytic grant making, which for us has the same kind of elements, I would say. So the intentionality, the attention to IMM, impact measurement and management, and these additional components. So now, of course, we're talking to funds. We're looking at repayable finance, but the discussion should also be then brought in when it comes to the grant making. And you will see, I think we just published something that is about the definition of investing for impact. So we want really to look at the picture in a comprehensive way. So looking at all the financial instruments that investors and foundations can use. And then maybe I would like to go back to the question from Ricardo, because the answer is also included in the report that Alessio shared. So basically, yes, when it comes to these 30% of investors that are not additional, but are still considered as impact investor, is because indeed they are intentional. So meaning that they have a theory of trade in place, that they have the intention written somewhere ex ante to generate an impact. And also they go through an in-depth IMM system. And as you will see, these are still investors that are supporting what we call, and Alice talked about them at the very beginning, enterprises that are contributing to solutions. So again, those investees that are included in the, if you look at the ABC framework, again, probably something that outside of our bubble nobody will know, but act to avoid harm, benefit stakeholders and contributing to solutions. Impact investors are those that are focusing on supporting investees contributing to solutions. So these are the impact investors. And then you have this additional feature, which is additionality. So maybe last, considering we have still a bit of time, I just wanted to ask you, Peter and Alice, a final comment on the collaboration. Peter, I think you mentioned, you mentioned co-investment. So I wanted to understand whether you believe that collaboration can enhance your possibility of being additional, and what was your experience in collaborating with maybe investors that were not considering themselves additional, or whether you were able to be more catalytic because you played a role in the collaboration. I'll go to Peter first because you mentioned this, and then Alice, anything about collaboration co-investment linked to additionality, it would be great to hear it from you as well.
Yeah, thanks, Alicia. I think when you discuss collaboration, the old good saying, it takes two to tango, comes to the place, right? And, not in all contexts, more collaboration means more added value, right? Some impact founders, they will generate the most value if we just let them be alone, right? And not be this hyperactive investor who will ask them 3 times a day how you're doing and how we can support you, and send them 3 questionnaires and 12 unsolicited connections to people they might be interested in talking to. So I just wanted to name it that it's, for me, super driven by context and by the character of the founders. And I believe any support needs to be solicited and mindfully sought after, right? And I also believe that, building resilience and strength and success requires being really mindful about our roles. And me as an investor, my role is not to be hand-holding the founder and creating this protective bubble. There are many, many different ways how the collaboration could look out, and sometimes less is more. So I think we also run into risk of overdoing things, and we need to focus on what really matters. And I believe that changing the world for the better is by itself really, really difficult. And we as investors, even with the best intentions, we can provide really, really bad advice. And because we're investors, we have a lot of influence. So I would just only advise to tread carefully with that energy in the constellation of investor and founder.
Thank you, Peter. Alice.
Yeah, I strongly agree that this kind of collaboration are key. And if I think also about collaboration among impact investor, or more broadly among investor, I know that on my perspective, there is a lot of collaboration among impact investors, thanks to network like you, thanks to different kind of element of context. But I think that where we can go further is by bringing collaboration among non-impact investor and impact investor, because I know that in France, it's a topic that we discuss a lot this year, the fact that we are kind of in our bubble, and maybe in a tense climate that that you are describing earlier, like the fact that there is less actor, we need to okay, we already I think united, but how can we also include and bring in the discussion non-impact investor to have a wider impact. To me, that's my current challenge.
Thank you so much, Alice. I think the comment makes super sense, especially considering the gaps. So we definitely need to enforce collaboration with actors that are outside of our niche. And actually, as Impact Europe, we have started researching on collaboration along the continuum of capital. So in case you would like to share any case or insights, you can reach out to us, and we will specifically focus, of course, on catalytic capital, but also on the 4Ps, which is the collaboration that is public, private, and philanthropic collaboration. So we would also like to see whether there is a possibility to collaborate more with the public sector, for example. So happy to share more in due time. I still have a few slides to conclude, but I would like to thank you both, Alice and Peter, for taking the time to share your strategies, but also your humble and honest views on your organizations and how you see the market and the ecosystem evolving. It's always good to know that we can count on practitioners like you. So I'll share for the last time my screen, and as said, you will receive the recording and the slides, and you can always reach out to us if you want to know more. As said at the very beginning, we will continue with the series. So next Monday, we will have a next webinar, which is about can impact reporting attract capital? So another way of looking at impact reporting, and we will be joined by Matt Ripple from Impact Frontiers and Matthew McGregor-Stubbs from UBS Optimus Foundation. And there will be a specific focus on how also foundations can use impact reporting norms to systematize the way in which they report on their impact. And the third one, which I already mentioned, will be on the 17th of July. And we will be joined by Gaetan Henriks from FITRAS and Risa Casimiro from Maze Impact. And the idea there is really to see how we can untap more capital coming from big players with a focus on corporations, institutional investors, but also foundations that can support impact investors. So you have the links here and the QR code, and Alice is sharing the links. Last but not least, we will keep discussing all these topics at our upcoming Impact Week, that this year will be in Malmo, in Sweden, in November. So as members of the community, you will get 2 free tickets. So don't wait to register until the end. It will be good to keep discussing about this important topic there. And last but not least, considering it's the first webinar of this series, we would like to hear your feedback. So we would like to see whether you have suggestions, whether you liked it, and whether you would like to see more webinars like that, where we can really play with data and then asking practitioner views to comment on that. I'm incredibly on time. Alessio is sharing the link of the evaluation form. And thank you so much again to Alessio for working on the additional analysis and presenting us the new insights, and to Alice and Peter for joining us. If you want to stay in touch, you should know where to find us. Enjoy your lunchtime. Once again, thank you all.
Thank you. Have a good one. Bye-bye. It's been a pleasure.
Bye.